It's 11 o'clock and I think we've got an awful lot to get through. So Andrew and I are going to run through what happened last year, looking at the investment companies sector by sector, basically. So we're going to sort of swap between us into what we look at. I'm going to let Andrew kick off and hopefully we'll all get wrapped up by 12. So
Splendid, thank you. Well, we'll do our best to gallop through all of this. There's a lot to cover. Welcome everybody, and we'll just have a look back to begin with at the sector performance overall last year. It was a very difficult year, obviously, particularly after Russia invaded Ukraine on the 24th of February, and that really changed the macroeconomic outlook completely and thrust us into this new world of inflation and higher interest rates, where investors had to then reassess the valuation of growth stocks in particular and their future cash flows. So the black line on the chart here is the performance of the closed-end funds index over 12 months. It's pretty poor, and it was down almost 20% on average, 19.8 in fact, over the calendar year. And the green line, it shows the FT All World Index, which actually mimicked it fairly closely. So effectively the investment trust index, being fairly global and diversified, performed in line with global equities. The blue line at the top is actually the FTSE 100 index, which was incredibly resilient because it's stuffed full of dollar earners, energy stocks, and lots of value in there. So that did much better. So overall, it was a year to forget for investment trusts, but as always, there was quite a lot of variation within that and some bright spots, which we'll come on to. So the global sector, though, there was nowhere to hide from that poor world stock market performance, down 14.3% in NAV terms over the year. Just to familiarize you with the format here, these charts are sorted by the 1-year NAV returns, so best ones at the top. I think we have to start really with Scottish Mortgage, which is the biggest investment trust. Many people own it, and it fell last year from the top of the performance tables to the very bottom. And that was just symptomatic of the big story, which I suspect James and I will come back to very, very frequently. It was the rotation from growth to value and the fact that growth stocks were derated massively. So Scottish Mortgage lost nearly 39% of NAV last year. So, that was a very, very poor year. The better performers in the sector were actually the old traditional investment trusts, which again, many people will own, AVI Global, Alliance Trust, Brunner, and Foreign and Colonial. They all held up actually pretty well because they were probably quite a lot more value oriented. I think the other thing I'll just highlight here is the de-racing that occurred on Linsell Train, which also did quite well actually in NAV terms last year, held up quite resiliently. But the shares were down 14.5% because they were derated, and now they trade pretty close to the NAV, which to my mind is just a return to common sense, after quite a long period where they were trading on a big premium. So I think that's it for that sector. I think we would expect global equity income to do better because it's bound to be a bit more conservative. Obviously, it's focused on dividend payers and there's going to be a bit more value in there. And overall, it really wasn't bad last year. Average performance just down 1.2%. British and American at the top there is a very small trust, so I think we'll just ignore that one for now. The main feature for me is the quite good performance of Murray International, which actually increased its NAV by 9%. And that's really down to Bruce Stout sticking to his staunchly value-based approach, which has been quite tough actually for him for a number of years now. And Murray International has been struggling in the peer group. But of course, last year, it was far, far better period for it. And I think that the current yield 4.1% is reasonably supportive there. The only real laggard, I think, in this sector was McHattie Investments, and to some degree that's irrelevant now because they've changed their investment manager from this month. So we'll see how they get on with Marylebone Partners.
Before we move on, I should have said at the beginning that if you want to ask questions as we go, we'll put them to each other as we go. And the first one's come through already, and it's basically saying, do you think Scottish Mortgage is good value now? What do you think the prospects are for 2023?
Yeah, that's a good question, and it's probably the most asked question of the moment. My feeling is that it's too late to sell, and it's probably too early to buy as well. I think inevitably its performance is going to be linked to how growth stocks get along in the US in particular. And my feeling is that those are linked to the path of interest rates. And that's a hard thing to call, but I think probably that picture may not improve until the second half of this year. So yeah, potentially you could dribble in some money, but I wouldn't be going all in at this point myself. But it's a tough one to answer that, James.
That's why I asked you.
Yeah, thank you for that. Global smaller companies, again, quite predictably, I suppose, they had a much tougher year. There was a rotation not only out of growth, but actually out of smaller companies as well, as investors sought to de-risk their portfolios and fled to the comparative safety of the bigger companies. In addition to the NAV falls, there was a derating of some shares as well. So the share price performances really were pretty awful in this sector. The only trust that managed to hold up a little bit better was Global Smaller Companies Trust, which that's one of those bland names that's hard to recognize now. That was BMO, Global Smaller, now managed by Columbia Threadneedle. So that was the best of the group. And I did notice a broker's note on the trust in mid-December from Stifel that reckoned that trust actually might do okay going forward because it's very diversified, had much lower stock-specific risk than many of its peers. So it did stand up a bit better last year. Global emerging markets, not too bad. I mean, minus 13% on average. I think the story here is probably not so much about the average, but about the outliers here. Because at the top, you had the Gulf Investment Fund with obviously very specific geographic focus there that helped it, because these energy producing nations there were in a much better spot than most others around the globe. That did really well. NAV up 22.6%, share price up just over 25. So that was a smart thing to own. And to some degree, actually, BlackRock Frontiers was in the same spot, because it does have a heavy weighting in these same Gulf states, 20% in Saudi Arabia, 8% in United Arab Emirates. And that trust has always said, actually, that it should be uncorrelated to other markets. And I suppose, actually, last year it lived up to that claim. It had previously been a slight laggard, so I'm sure that was a great relief to many holders. At the bottom end, you've got JP Morgan, Emerging Europe, Middle Eastern, as it's now called. That was JP Morgan Russian, so that's, that lost 94% of assets for a very obvious reason. The Baring Emerging Opportunities down there as well also had heavy holdings in Russia, and as did Fidelity Emerging. So effectively, your position in the ranking last year really depended on how much Russian asset you had at the start of the year.
Good. All right, thank you. So flexible investment then. Peer group median return 3.5% down. Obviously, a lot of the funds in this sector are supposed to be trying to preserve your capital, so they shouldn't have been falling too much. And most of them did relatively well. At the top of the list, we've got JZ Capital Partners. which had a really awful couple of years before that, where it made a sort of foray into real estate and regretted it and missed that off. But now the old business, that's sort of private equity, small mid companies in the US and Europe, that's doing a bit better. So they've made some profitable disposals. That's what's driven the NAV performance there. And I think the relief factor that they're not struggling with their debt problems that they had so much is what's driven the rally in the share price. The global opportunity success is really down to sort of value type bias. JP Morgan Global Core Real Assets, JARA, all of those sort of infrastructure things have been marked up over the year, but as we'll see later on, infrastructure generally people have been sort of shying away from. I think because they're worrying that higher interest rates are going to depress the valuations of these things. That might be a real problem. So it's not surprising, I think, that the share price hasn't caught up with the NAV. At the other end of the table, you've got UIL, which is a pretty sort of eclectic portfolio. And it's also geared into market falls because it's got quite a lot of zero dividend preference shares. CT Global Managed Portfolio Growth was one of the best performers last time, and it had a lot of Betty Gifford type funds, and that's the reason it's fallen. Castleknoll is a strange beast. It's popped up in the news today because it's actually seems to be bidding for Dignity, the funeral company. So read more on that on our website. But of the funds that are supposed to be, the key ones that are supposed to try and preserve your capital, the best performing one of those was Ruffer, and then capital gearing, and then personal assets. But there's not much in those two. So I think they did a reasonable job, which is probably good news considering that the amount of money that's been poured into them in the last few years. No, Ricky would not be further up the rankings, to answer that question that's popped up there, really because it's not designed to shoot the lights out. It's designed to kind of steady eddy stuff. Right, now, I'm going to move on to the UK now. So looking at this, the peer group median is pretty bad, down 22.4%. And if you remember the chart that Andrew put up at the beginning about where the all share finished at the end of the year, really this was a pretty awful year. The only fund that matched the index was Fidelity Special Values, and everything else underperformed. Fidelity obviously has got more of a kind of value bias than some of the other more growthy things, which helped it. But mainly the problem here is exposure to small companies. So the more exposure you was perceived to have to the domestic UK economy, the worse you did. And that's probably why JP Morgan Mid-Cap did badly too. Obviously, we know what happened last year in terms of that and the mini budget and change of leaders and everything else. And obviously, our economy is now forecast to have the worst recession of the dollars of developed market. So not particularly rosy outlook either, I think, but we'll have to wait and see where we go. The equity income funds is a similar picture to the global ones. So they did a bit better. You actually got some that actually beat the all share there. But again, it's very much a sort of down to the style of the way that you manage the money. So if you have more a sort of yield-driven style, then you don't tend to outperform. If you tend to sort of manufacture income or actually invest in relatively low-yielding stocks, you lagged a bit. And the other big factor that was affecting these performances was with how much exposure you had to small cap as well, given how badly small cap did relatively. And Chelverton UK dividend is geared into the fall in small cap because it both holds that sort of those sorts of stocks, and it's also got zero dividend preference shares that gear it. So that was the issue there. James Piggott's asked a question about RIC Capital, which I don't feel qualified to answer at the moment, to be honest. So he's asking whether it might have to revalue its unquoted downwards. I think that's a common problem. This is kind of what I was alluding to with JARA, that some of those valuations might be going the other way. But RIC Cap is supposed to have a lot of offsetting hedges and things in place to protect its portfolio. So we'll have to wait and see how that works out in practice. And then with Alex Wright, Total Special Values, so it's going to go back a page. If you're going to hold it and a more growth focused one, I don't know. I think I might go with BG UK because that's the obvious counterpart to it. But I think actually there is a recovery story, sort of return to the median, return to mean rather. So for mercantile and mid cap, and I'd probably favour those two. Right, sorry, I'm going backwards now. Let's go forward again. Small cap. So there's some huge divergence in the performance of the funds in here. A lot of that, there's a pattern around liquidity. So the small cap things you're investing in, like some micro cap things, the worse you were doing. And that definitely is true of the River Mercantile micro cap down there, NSV and UK emerging. But at the other end of the table, the Roxwoods and Crystal Ambers and Odysseans, they're all things that are investing in businesses that they think have a higher intrinsic value than the market's actually placing on them. So that they think that they're investing in undervalued companies, and that crucially that value can be unlocked. And in Rockwood Strategies' case, you've seen a number of bids. So most recently, it's had bids for one of its biggest holdings. And that's true of Odyssean too. And that seems to be a pattern that I think might carry on through to 2023. We might see more bids in the UK market, just as overseas investors take advantage of relatively weak sterling and obviously low valuations. So more of that, I think, to come. And then on the value versus growth side, that's most obvious there. If you compare the performance of the Aberforth funds with the two funds, BlackRock, Morton and Aberdeen UK Smallers, which used to be Standard Life UK Smallers, down the other end. That's the straightforward value versus growth problem.
Thanks. Thanks very much, James. We'll move on geographically now to the Asia Pacific region, where the performance again pretty much as expected, I think, down 12%. The obvious thing to talk about again is the Baillie Gifford influence and the fact that Pacific Horizon, which just swept the awards at the ceremonies in December, had a terrible year compared to the peer group with a loss of nearly 20% of NAV. It's still the best performer over 3 and 5 years because it had built up such a tremendous lead before. So I think one should be wary actually of thinking negatively about it, because of 1 year's performance, and the managers would obviously say the same thing. But it does have big positions in internet stocks in particular, and also semiconductors and other techs. So it's bound to be much more volatile than many of the peers here. I think the interesting point to say about it, which doesn't require too much judgment, is the fact that it has moved from a premium rating a year ago to a discount of 5.7% now. So you're not paying up for that Baillie Gifford management quite as much as you were. So a bit better value there now. If you are looking for something a little bit more steady in that sector, then Pacific Assets, I think, is the one that stands out as being pretty good over all periods. The income ones, again, very much as you'd expect. They were much more resilient because they're targeted at dividend payers. A couple of trusts that do stand out here. One is Henderson Far East Income, which I think has the highest yield of any equity trust. Certainly it's the highest one I can think of, 8.7%, which is quite dramatic and actually is very often questioned. But to me, it looks very solid. I don't think there's any reason why that won't be sustained. So if you are looking for a very high dividend yield, then that's one to think about. I think it does limit the scope for capital growth though, and that is obviously a prime reason why people invest here. And if you're investing in Asia Pacific income, you're probably looking at total return, in which case Schroeder Oriental, I think, is the better, that has the best track record over a period of years. I spoke to the manager a couple of weeks ago, actually, and it seems very well positioned. It has an underweight position in China, which has obviously been quite useful. It it seems a little bit odd at first that it has 20% of its assets in Australia. But the argument there is that the Australian economy is very much linked to the performance of the Asia Pacific and has a lot of trading links and so on. So it does make sense. And actually, if you want some Australian banks in there to get your income up, it's quite sensible. That's quite value oriented as well. And generally there, I think the payout, which is 4.4%, again, looks quite well backed because the Asian companies generally have more conservative balance sheets. And so, I think if you're a bit worried about your income stream for the future, that might be one to think about. Smaller companies had a bit of a surprisingly good return, actually. I mean, you might well have expected them to have been down by a considerable margin last year, and instead it's our first positive one. There we are, up 6%. I'm not entirely sure why that happened, but it helps that Fidelity Asian Values at the top there has a very, very definite value style, which has been very well articulated. I think the point I would make about that is that, honestly, that's been such a terrible drag on its returns for the last few years that it must have been so tempting for the manager and the board to cave in a little bit and to say, well, actually, all right, we'll put a few growth stocks in there. But as far as I'm aware, they really didn't. There's been very little style drift. And I think as an investor, that is what you want, actually, because you want to know exactly what you're buying into. So, bravo for hanging on to your value style there. I can just see there's a question there about EGL. Yeah, I mean, I will follow up on that in due course. I don't think I have anything particular to say about it right now, but I'll be back to it.
Cool. I think actually one of the other influences on that return didn't have a lot in India for those Asian values.
No, although I'll come on to India in a moment. And India was actually, again, it wasn't terrible. It wasn't as bad as China.
Yeah, exactly.
I mean, for obvious reasons, China had a very difficult year. I mean, zero COVID policy, was such a terrible drag on the economy. It has just opened up, so we'll have to see how that goes. And of course, the initial excitement about China's reopening was somewhat tempered by the fact that COVID infection rates went through the roof and caused a few shutdowns because people couldn't go to work. So we'll have to see how that plays out, but there's quite a lot of optimism now for the coming year and a return to normality. So we'll have to see how that plays out for Chinese equities. But it was a very difficult year, down 19% on average. I mean, actually, that if you look at that figure and then you look at the 1 year NAV returns in the column, they don't quite mesh. That's because there's been a big rally in the last couple of days, and the 19.1% is the calendar year change. Not surprisingly, Baillie Gifford again at the bottom there, because it's more growth oriented, lots of Alibaba and Tencent in that portfolio. Inevitably, one question that will arise is, well, now that China's reopened, should I buy in? Thank you for the question. Yeah, I'm not sure it is a clear buy, actually, because I think it's a bit too simplistic to say, well, because the economy is reopening, everything is going to be rosy now. I think that might not be the case. And the value isn't fantastic. I mean, the average discount is 9%. It doesn't particularly draw me in. I'm a bit wary of single country funds unless they're really good value. India did have a fairly flat year, actually, within the investment trust sector, which isn't bad at all because the previous 2 or 3 years have been very good. And so if it's consolidated those gains, then that's fine. It did start the year quite poorly, actually, and then picked up. So, perhaps that's a cause for optimism for the year ahead. I do find it very difficult to call these markets, these single markets. And obviously, quite often people would like to know whether we prefer China or India. I find it impossible to answer with any useful information. I can give you my view, but I'm not sure that's very, very handy. In this case, there's not too much to say about the trusts. They were all tightly clustered, but a shocker India equity is the one to have if you're looking at a 3-year period.
I've been asked, China or India.
Go on then.
I do. Well, I think that this ending the zero COVID policy in the way that they have is probably shoot themselves in the foot again. So it probably is not helpful, like you say. With India, the problem is the high valuations. So they're sustained a bit by the incredible earnings growth that they're getting. So if that can be maintained, then they're justified. I think that the momentum in India is probably going to carry on for a while yet. But by the time we get to the end of this year, it'd be hard to tell which one would do better, to be honest.
Elsewhere, Vietnam had a very difficult year. I'm quite glad that I see you've got the manager of Vietnam Enterprise on the show coming up next week. So that will be helpful, because I think I've read quite a lot of mixed reports about the outlook for Vietnam in the coming year. So I'll be very interested in that. Certainly, it was a bad year all round, and it was a bad year for Korea as well. So there's probably a bit of value here. I mean, the Vietnam trusts have tended to be on wide discounts anyway, and they did widen a bit more last year. So I think there's some value if you feel the underlying markets are going to do well, but they certainly had a very rough year last year.
Yeah, it would be my pick over China and India, I think, Vietnam, just because the valuations have come back.
Yeah.
There we go. On to Europe. Again, it's a straightforward value versus growth story really here. So Europe's at the top and European small cap down the bottom. You can see again that the small cap funds tended to underperform the large cap ones, the common pattern apart from in Asia. And again, it's the Fidelity funds with the value style that's topping the table, and it's the Bailey Gifford fund with the growth style that's at the bottom. So it's quite a big pullback for a Bailey Gifford European. It's not really looking too clever for it. So they do need to start to come good soon, I think. Otherwise, people are going to start questioning whether that makes sense. The real disappointment, I suppose, in the small cap thing has been Montanaro European. I do like that fund quite a lot. It's sort of a nice, solid approach, and they back sort of quality companies without too much borrowing and that sort of thing. I think those are the sorts of companies that should be able to better navigate what's going on in Europe, given obviously that there's an awful lot of economic headwinds because of what's happening with the energy prices and general recession anyway, and inflation. Although inflation does seem to be coming back down again, which is helpful for the short term anyway. So if we were looking for a sort of bargain to pick up, I'd be more on the Montanaro European side than on the Bailey Gifford European growth, I think. Back to Andrew.
So when I looked at the returns from the Japanese investment trusts, I saw them down 16%. I was slightly puzzled at first, because actually the market, it really hasn't been that bad in Japan. If you look at the market indices, the topics in sterling was only down 4.4% over the year, and the Nikkei was similarly much better than the investment trusts. So so I looked at it and came to realize that actually the 4 investment trusts that are really looking quite poor on the list here are all very growth oriented. It's not just Bailey Gifford, but the others as well. And that they all address that with varying degrees of honesty in their reports. But basically, they were all caught out by the big rotation. It doesn't help that all of these trusts employ double-digit gearing as well. But effectively, it's just down to their market positioning. So Schroeder Japan Growth is much more, in spite of its name, it's less growth oriented. And CC Japan Income and Growth, for obvious reasons, it's targeting a bit of income. So those were the more resilient ones. It may well be that actually something like JP Morgan Japanese, which does have a decent long-term record, it may well be that that will come back next year, but it's certainly a very rough time to be in these large investment trusts. As we would expect, smaller companies did a bit worse, down 22%. Again, they're very growth oriented. Bailey Gifford Shin Nippon is an obvious one in there. But there are two trusts here which did do quite reasonably last year. Nippon Active Value Fund and AVI Japan Opportunity. And they have something in common, which is that they're both targeting companies that can benefit from an improvement in their corporate governance, and perhaps they can unlock some hidden value there. And they've both done quite well, actually, which I think indicates that this is a valuable theme. And my feeling is that it could continue for a number of years. So I quite like these trusts, actually. Even though it's tempting, I think, to buy the ones that have gone down a lot, these ones, I think, do offer quite a good, valuable, rationale. And if we look, for example, at Nippon Active Value's portfolio, there was a good example in November of what can happen. A company called Teikoku Electric was up 20% because it doubled its dividend and announced a buyback program. And that's exactly what that trust has been looking for. And it's decent value, I think, that one. It's probably not that well known. It's a bit smaller than some, but it's on a 13.8 discount, which I think is quite attractive. So yeah, that's one to look at. North America, just as I was surprised by the poor performance of the Japanese investment trust, I was also very surprised to see that this was flat, because the S&P was down by I'm not sure what the percentage was, about 10, I think, maybe a bit more actually, and the Nasdaq actually it was more than that, and the Nasdaq by even more like 30. So I was expecting quite big falls here, and we did see a few. I mean, Bailey Gifford is the outstanding one. That was a really dreadful year for Bailey Gifford US growth, down 41% there. But here the average was helped very much as a weighted average, and that was helped by Pershing Square Holdings, a big trust which actually did very well. It managed to increase its NAV over the year. And I have slightly mixed feelings about this trust, because it all boils down to the manager, basically. Bill Ackman will do his own thing, and you've got to back him or not. And that's why, in spite of this good performance, which has been continuing for a few years now, it's on a massive discount of 32.7%, because there are governance concerns, I think. But it's one to think about. I mean, I think there's a lot of value there. And on the subject of value, the same thing applies here as we've seen in other markets. So the North American Income Trust, which has been a bit of a stinker for the last 3 years or so, actually came back to the top of the table because its value, its income, it's exactly what you wanted in this market. The only other one I'll just mention quickly is Canadian General Investments, which we don't cover a lot. It's not in all the performance tables. It had a bit of a disappointing year, down 15%. Probably not what you'd expect from a market which has quite a lot of natural resources and banking. But it does have actually quite a lot of IT in its portfolio, and it had a big holding in Shopify, so it had a bad year. North American smaller companies were down, again, not too badly actually. There's only 2 trusts here, but they were both down by high single digits. I don't have too much to say about those really, just that the JP Morgan Trust did again outperform the Brown Advisory one, which it's tended to do. I think it's all fairly priced. The discount ratings seem to me to be quite apt for where we stand. Now, one of the bright spots, one of the brightest of all equity spots last year was Latin America, up 16%. Both trusts in the sector did reasonably well, decent positive double-digit returns. Actually, the income fund did better than the BlackRock one, again, because it's value and income. This looks pretty dramatic and exciting at first glance, but actually nearly all of the gains here occurred in the first 4 months of the year. And then after that, it's been quite dull. So yeah, I think it was all about the market bouncing back because it had been very poor previously and held back by political unrest. And my feeling, I think the thing I can take from this and learn from it is that probably if you're thinking about buying into Latin America, then historically, if you've bought it when there's been some kind of terrible political scandal, that's been the right moment.
So that wraps up all of the equity sectors, which is good. We are making progress. Biotech and healthcare, so specialist equities now. And the winner here is, by some margin, is the Polar Cap Global Healthcare Fund. And that, I think, really comes down to the fact that sort of general healthcare has been outperforming biotech, so for quite a while now, for the last couple of years. And that's obviously Polar Cap Global Health has got a broad spread of investments, but not much biotech. Same should be true of World Healthcare, but it's chosen to have a bit more biotech, and that hasn't worked out for it. We've had a couple of specific wins in portfolios, things like Sucona, which is towards the end of the year, that helped, and RTW too. So generally, it wasn't an awful year, but definitely biotech has been lagging. We have seen a bit of a start of a catch up in the last few months, and I think that comes down to the emergence of bids again. So as Big Pharma looks for more exciting drugs for its portfolios, it's fishing in the biotech pool, and I think we could see a bit more of that going through 2023. Back to Andrew.
Yeah, commodities. They had a good year. Obviously, in an inflationary environment, commodities can do quite well, and they did, helped by energy in particular. So Riverstone Energy was the top performer. It did very well at the start of the year when energy prices suddenly ramped up. What's interesting here is that this trust, which has had a few governance concerns and probably still does, it's been really trying to narrow its discount with buybacks, and that hasn't worked very well. So the discount is still very wide at 42.8%. And it's an interesting trust that is pivoting from its old oil and gas holdings to renewable energy. So I think that's one to think about. Many people will own BlackRock World Mining, which had a good year. And you had the dividend as well there, which is quite healthy, although I think it might be a little bit lower in the year ahead. I think most of the trust did pretty well, but there are some at the bottom there which really had a bad year. Baker Steel Resources Trust is one of those, which is a very unusual trust. It's quite quirky. It has, small holdings in smaller mining companies and some unquoted stuff as well. It has underperformed, and not just over the last 12 months, but previously as well. And I think it's really in need of a bit of a win now, because I think even if you're quite patient with it, as I have been actually, I think it's getting to the point where you'd like to see exactly how some better returns. So we'll see if it can deliver in the coming months. The other thing I think is outstanding there is Gold and Prospect Precious Metals, because if ever there was an environment where you might have thought gold would really flourish, it was last year, right? When we had terrible political unrest, big increases in inflation, lots of uncertainty. You would imagine gold would be a brilliant safe haven. And it had a quick rally in the first quarter, but then pretty much all of those gains disappeared. So I think in the end, it's no great surprise that trust was down 25%, and gold has been a disappointment. But some interesting stuff in that sector.
So environmental, not an awful lot to say here, except that after a few years where ESG has been sort of the headline, I think there's a bit of fatigue going on now, and people aren't quite as excited about that as a sort of concept by itself. So I think it seems to be more ubiquitous. And also, because of the nature of these funds, what they're doing, there is a bit of a bias, definitely an impact towards growth type stocks. which obviously has not been helpful. So I think people just taking some profits and moved on some of those. Swift, back to
tech. I mean, obviously a disastrous year as growth stocks were revalued, or we should say devalued, really, down 31% on average. Both of the big trusts, where I always like to see at the end of the year which one was slightly ahead, because they tend to be pretty close. They were both down more than 30%. Polar Capital is slightly better than Allianz Tech, but Allianz Tech is still better over 3 and 5 years. I think the discounts there of 10 or 11% are okay. They don't particularly draw me in. I think possibly more interesting is the share price performance of Augmentum FinTech there. And you know, this relates to a question that was asked earlier about the valuation of unquoted elements in portfolios. And I think this could be one of the big stories of the coming year, you know, because a lot of trusts have been priced down in share price terms, while the NAVs have held up on the basis that, you know, the expectation that those NAVs will be coming down sharply. And of course, this year we'll see how that plays out, you know, whether the NAVs do come down, in particular for unquoteds, or whether in fact they held up better than expected and therefore the sell-off has been overdone. I think that's going to be one of the big questions of the year, and that's very important, not just for this sector, but also for real estate and for private equity. My feeling is that quite a lot of the share prices have really sold off quite strongly here and are quite pessimistic. So we could see some bounces, but we'll have to see how that one plays out. Debt. There are a few different sectors here that I'll run through quickly. Actually, I'll just answer the question if I was going to buy one tech fund. My sense on that one is that it's really difficult to judge between those two big ones. So I'll just buy the one that's on the biggest discount at the time, and perhaps own both. Sorry, I'm hedging my bets there. It's not a useful answer, but it is a truthful one. Debt was actually a pretty good sector overall last year. A lot of good returns here, a lot of good solid returns. We didn't see very many problems. I mean, when debt trusts blow up, it tends to be quite dramatic. Last year actually wasn't bad, and overall we didn't see many credit defaults. We'll see if we start to enter nasty recessions across the world, whether that changes. But last year it wasn't bad at all, and quite a lot of the trusts did do very well. So I quite like this sector actually. And if you are looking for yield, some of the yields here are really very enticing. You know, you can get 7 or 8%, occasionally higher, and there's some very good value about. I think that Riverstone Credit Opportunities Income is interesting, and there's a corporate event coming up there as well, which, you know, could mean that some extra value is realized. So, you know, that's worth having a look at, and there's a good yield on that. I think trusts like Biopharma Credit look quite solid. Again, very nice yield. They paid a special dividend last year, which made it even higher. And they don't look particularly highly valued to me. One curiosity is Pollen Street, where, when this used to be a straightforward debt fund, it was basically a lender that stepped in where the banks didn't want to tread, and did very well, paid a very high yield, very good dividend. People liked the trust, and then it bought its manager and changed its spots and said it's going to reduce its dividend. And I think that upset a lot of holders. So we had a big sell-off, and the shares are down 37% over the year, even though the NAV is up 10%. So the discount has widened out massively to 47%. And I've had a look at it, and I can't really see anything wrong there. I think it's just perhaps that there's maybe a bit of worry about credit defaults, but actually it's been a good portfolio so far. I think it's more to do with this switch and buying the manager, which has upset people. But actually, even if you, and they said the dividend was going to go down in steps, but even if you base now the dividend yield on the bottom step, so where the dividend ends up, you're still going to get a prospective yield of over 9%. So I don't know, sentiment's right against it, but we'll see what happens there. The other one to mention is VPC, specialty lending, where basically shareholders were agitating there to realize some value. And the board has now caved in and said, yeah, okay, we'll propose a winding down. That might take maybe 2 years, and some of the value there in the equity stakes it holds is a bit uncertain. But I think if you're patient, you probably will get some decent extra value out of that one. So I would hold on to that. Structured finance, a bit more of a mix here in terms of the returns. Some were good, some were not so good. I don't know too much about these trusts because I find them very difficult to understand. And my general belief is if you can't understand it, you shouldn't invest in it. But Blackstone loan financing, I think, is interesting. It is a complex trust, and I've always shied away from recommending it fully because I just don't feel I have an adequate understanding of all of the variables. But I do think, actually, if you are a sophisticated investor and you're prepared to look at it yourself, there's got to be some value here. It's offering a 12% yield, and its share price went down last year in spite of a 12% NAV return. So, you know, I think if you're prepared to dig into it, you could find some good value here. Next up, loans and bonds. Maybe not an obvious place to invest during a period of rising interest rates, but actually some of the trusts did okay. So one I tend to look at is CQS New City High Yield Fund, managed by Ian Francis. When that's a traditional bond fund, actually did okay last year, pretty flat. You know, not an exciting return, but possibly a bit better than I expected. And again, the yields you're getting here are very good. So you can still get an 8.3% yield on that trust. So if you're prepared to look at bonds, and it may be actually a slightly better thing to do in the year ahead than it was last year, then again, some good value here for income investors. And the last bit of debt is property debt. And here I think there is one outstanding trust actually, which is at the top of the list, Real Estate Credit Investments. I own this trust, I like it. I've owned it for quite a while. It seems to actually have very, very steady monthly returns. And it's also, I think, possibly going to benefit from the fact that other property trusts are disappearing. So Starwood European Real Estate is winding down. ICG Longbow is winding down. So I think if you're looking at this sector and you want a decent sized trust that is fairly, you know, conservative in what it does, then Recce is one to look at, and you're still getting a yield there. And I mean, it's come up actually quite a bit this week, but in spite of that, you're still getting a yield of 8.8%, which is pretty good.
Cool. A couple of tiny sectors for me to start off with. So Foresight Sustainable Forestry is now the only one in its sector, and it seems to have made a reasonable start. Although it is, I think, too early to tell how these things are going to play out in practice. It's talking about prospect for lumber prices and that sort of thing. We'll just have to wait and see, I think. So I'm still interested, but slightly wary. On the financial side of things, I thought that financials was going to be, you know, this was going to be financials year, and it would have been had it not been for the fact that we now have looming recessions, which were not the case at the start of 2022. So the PCFT managers are quite adamant that the bank sell-off is overdone, and actually people are being overcautious about the outlook for bad debts within banks. And actually, from their point of view, things are still quite cheap, and now's the time to get in. So that's going to be interesting. Trine Investors is a sort of single asset fund, so it's a bit peculiar. It's for a lot of argy-bargy between it and its shareholders. It's going to wind up, so that's probably the main reason for the main difference between its NAV fall and its share price rise. That's what's caused that. growth capital has probably been the worst place to be over 2022, as we know. We know about the whole self in growth. There's really, I think it's more about the share prices and the NAVs in here. Although it is interesting that some things still haven't marked their NAVs down, and I suppose this is what Andrew was saying earlier. So things like Seraphim, most of its portfolio is still valued on the basis of what they paid to get invested, rather than on any kind of multiple that reflects what's going on with market prices for unprofitable stocks. I do think it's interesting as a long-term thing, but we could see quite a lot of fall in the NAV for that. The other scale, although Chrysalis looks pretty awful, down 38%, a lot of that's Klarna. And I wonder whether actually this is actually reached the bottom now, definitely in share price terms, and we could start to see a sort of recovery from here. It's all really down there to whether they can actually sell an investment or not. If they manage to sell one of their larger investments, they're adamant again that if they do that, it's going to be a premium to the current NAV. Then, well, free up some liquidity, then actually sort of buy back some shares, and you could see the whole thing being really transformed. So quite a sort of rally. We'll see. The one that I'm very wary of from a share price point of view is McHattie, because it's on a much narrower discount than the others. So I think the median discount of 6 is about 49, and it's on about 19. So I think that could have further to fall if sentiment continues against this sort of area. Hedge funds.
Yeah, hedge funds. Obviously, another sector like flexible meant to protect your capital, and it did last year, up 6.7%. So well done. However, that doesn't mean the returns were good across the board or indeed consistent. There's quite a range here. The obvious one that stands out, and it's not the first time we've said this, it does seem to be a really outstanding trust in the sector, is BH Macro, where you can buy sterling shares or dollar shares. Interestingly, this trust specifically says that it does better during times of economic difficulty. On its website, it says, higher returns are achievable during market environments in which risk assets underperform. And that's exactly what happened last year. So it was a really good year for the trust, 35% return on the dollar shares there. It's using all kinds of macro, directional and value strategies, lots of foreign exchange, fixed income. It'll vary quite widely. What is interesting about this is that you might well think, well, are its returns all generated in one massive trade that does brilliantly for them and pays off? That doesn't seem to be the case. Their returns were actually very consistent throughout the year. In October, actually, they did have a slight fall, but the first 9 months of the year, they made money every single month. And so, it may be too late now to buy into it on the basis that you want to use it as a way of diversifying your portfolio and hedging against losses elsewhere. But it's certainly one to think about for the next time around, because this isn't the first time that BH Macro has performed this function actually very well.
So, infrastructure. The NAV returns here aren't too bad, as you can see there. So, median return of 10%. There is a lot of variation within that. There are some newer funds in there. So, obviously, QuotedData's Digital 9 patent infrastructure, that the portfolios are only sort of just getting going, and so you wouldn't expect much NAV appreciation yet. There is the standout winner again is 3i Infrastructure. It's been fairly consistent. And that's because it takes on a bit more risk than some of the more standard PFI, PPP type funds. And it's interesting actually that Pantheon Infrastructure, which is currently trading on discount, is trying to emulate that sort of approach. So it's going to be interesting to see if it can pull it off and actually catch up then. So that's a story though for this coming year and the year after, really. Sequoia Economic Infrastructure was exposed to Bulb. and that took a chunk out of its returns. But that can't be the only problem, because that definitely wasn't all of accounting for all of that NAV fall there. Infrastructure in India is a perennial nasty, and stay well away. It's now bust, we think. The debt now exceeds the value of the assets. So those are the things that are directly invested in infrastructure. The ones that are invested in infrastructure securities, Ecofin, Global, and Premier Miton. Ecofin, Andrew's already mentioned it, actually did very well relatively over 2022, and it's a fund that we quite like. And the reason why, part of the reason why it's diverging, because the questions popped up there, it's just probably going to, is partly is because the Premier Miton is geared with zeros, and so that it's sort of captured the downside. And also Ecofin always seems to me to be a bit more cautiously invested than Premier Miton. So Premier Miton has been sort of ventured into China and come out again, and sort of emerging market type stuff. The Ecofin is more sort of steady Eddie developed markets, which I think I quite like, and also a reasonable yield as well. In the leasing sector, we're basically talking about planes and ships and the SLF realization. So SLF realization is slowly disappearing, so that's all good news, and that's reflected in that improvement in the share price relative to NAV. But in terms of the planes, the big news and why Medio soared is really because we finally got somebody willing to buy an A380 plane. There's been a question mark almost ever since these funds got going about who was going to buy these A380s when they reached the end of their lease life. So I think they're about 12, 13-year leases. And Direct Emirates A1 has actually come to the end of its is, and Emirates bought the plane off it for less than I thought it was worth, but nevertheless, they did pay some good money for it. And that's rekindled interest in all of those funds. So you've seen some rocketing NAVs. And the ship side of things is very good. And they've sort of come from strength to strength, really. And that's partly because supply chains have been so mucked up that you've had a lot more ships at sea. You had problems with not being able to get into ports, and so you needed more stuff, more ships for that. Obviously, the tanker market has been very good because of the demand for LNG. There are lots of things playing in its favour, and they do keep saying that not a lot has been built in terms of new chippage, so tonnage. That's what I'm trying to say. The conditions seem to be still in their favour. The interesting one there is maybe Tufton, although you've got quite a big gap between the NAV and the share price returns there. I think that's because people are a bit wary about what happens in recession. But I would say, yeah, these things might now be worth a look. Private equity, generally, there's a big difference again here between the NAV returns and the share price returns. The one that stands out there in terms of the NAV return is Literacy Capital book. So it's only a relatively new fund, and it came to market with a mature portfolio. So it's been able to get some realizations from that at really quite attractive uplifts. And again, we keep banging on about this, that when these companies do sell investments, they do tend to recognize a big jump in the NAV relative to the previous valuations. And that's been true of Literacy Capital. It's also been true of Oakley Capital too, which managed to achieve quite a lot of realizations this year. So it looks as though these things are all moving in the right direction. Obviously, if you've got more kind of tech exposure, you've been held back a bit. So that's hurt things like Apax and HG. Symphony, there is an Asian thing. The one that is the bottom of the table is EP Special Opportunities. It's got a too concentrated portfolio. So it's got an investment in a thing called Lucico, which is a lighting business, and that share price fell quite sharply over the year. And the Seed Innovations, the cannabis thing, that's sort of the shine's come off that. But I also want to single out Princess Private Equity because it's had a really terrible year, not just in terms of what it's done with its NAV, but also sort of shot itself in the foot with its hedging strategy. So it's tied itself up in knots by trying to hedge its NAV exposure. and now finds it can't pay its dividend and it can't make any new investments. And I think I'd steer clear of that for a while yet. And then renewables. So again, this should have been a really great year for renewables, and totally in terms of NAV, it was. You've got the main driver here has been inflation, because that helps NAVs quite considerably. It helps on the subsidy side and income side of things, and that sort of feeds through as long as the subsidies last. Within the sort of different sectors of the renewable sector, batteries have been doing particularly well, because they're building new projects, and then as they energize these, they get an NAV uplift, and that's what's been driving Gresham House and Harmony Energy, and also Gore Street, but Gore Street less so. I think that might be able to play catch up a bit this year. It's interesting that Greencoat UK Wind didn't do very well. I think that slightly comes down to the fact that there was actually a lot less wind resource than there should be. So they didn't generate the power that they thought they were going to, and I think that's held back returns a bit. And then the other pattern that sort of feeds through into this is that there were a few funds that launched and then struggled to invest the money, or did it much more slowly than was anticipated. That applies to Trato, to Aquila, and to Triple Point Energy Transition. And those funds have been quite significantly derated. Trato bounced at the end of the year. It basically came back and said, we've been holding off doing deals because of uncertainty around where interest rates are going. But now we think the deals we are going to do are going to be coming at higher rates of return than they would have been otherwise. And people seem to have embraced that, and the discount's been eliminated just in the last month or so. We'll have to wait and see on that, whether that works out or not. And then the other one that's sold off is hydrogen one, because it's different to everything else in that sector, and it's really a growth play, a bit of something like surf and space really, but in hydrogen. I do think it might be interesting. Quite a lot of people keep saying that the hydrogen is the answer to our problems with natural gas, and the need to do something about that. So we will see. But it's interesting. I was talking to the county infrastructure people recently, and they're invested in the national gas transmission network on that basis, that they think hydrogen is going to be the thing that replaces the natural gas in the pipes. We will see. Back over to Andrew.
Royalties, probably this is one of the strangest stories of 2022, I think, that these song royalty trusts have always been pitched really on the basis that they give you great diversification possibilities, because they're completely uncorrelated to everything else in your portfolio and should not be affected very much by macroeconomic conditions, because the demand for music is very inelastic, and therefore they should be a good solid thing to own. Now, if you look at the 24% decline in Hipgnosis Song's share price over the year, that rather suggests that's not the case. But actually in NAV terms, they did very well, up 34% for Hipgnosis and 24% for Roundhill. And so you've got this massive disconnect here. I think probably the biggest across all of these sectors, this massive disconnect between NAV performance and share price performance. And you can see that in the chart here, which is Hipgnosis. You've got the NAV in the green and the share price in blue. So you've got this enormous discount has opened up. And that leads to the question, well, you know, does it make sense? Is there terrific value here? Should you be jumping in? I think many people do believe that, which is why we've actually seen quite a good rally in these share prices over the last few days, Hipgnosis in particular. And it does lead to that question, well, you know, why has this happened, and what is the correlation, and how do I make sense of this? And I think the answer all boils down to interest rates, actually, that yes, if you look at the underlying economics of the music industry, It's exactly as described. It is all uncorrelated. The demand for music has held up. The streaming is still growing. Mariah Carey's #1 Christmas hit, still generating good money for Hipgnosis. So that is all working. And it's backed as well by the tailwind of higher royalty rates for artists. And there was some news on that the week before Christmas, which was also very good news, that the royalty rates are going up from 2023 to 2027 in small steps. So the underlying economics all look very solid to me, but it all boils down to interest rates and the fact that these companies do have quite large amounts of debt. That's been a problem for Hipgnosis. They had to refinance that and didn't do so at particularly attractive rates. And then the other thing is that their portfolios are valued on discount rates. And as the discount rate rises, the NAV comes down. And there's been quite a lot of discussion of that. And so far, the valuer has said there's no need to change the discount rate. And it's held up. We'll see if that is maintained. But even so, I think the discounts are so wide here that there is some value there. And you can get paid a decent yield of 5% or so to sit around and wait for those gaps to close. So I'm certainly a holder in this sector, and I think there's some good value there. I was just asked who values Song's portfolio. There's one particular company based in New York. They were called Masaski, but they changed their name, and I can't remember what they've changed it to. But they value both Song's portfolio and Roundhill's. They are the leading valuer in the sector. But rather curiously, last year they said before interest rates went up in America, they said they weren't going to change their discount rate. But anyway, they do it, and they're obviously an important player in that sector and in your consideration. Moving on to the first of the real estate sectors, this is the basic UK commercial property, the old standard, investing in offices, retail, and across the sector with industrials as well. How much you had in industrials was an important factor here for your performance last year. Overall, in NAV terms, it was pretty good, up 7%, but really, again, not so good in share price terms. And it's exactly that same question again. How much of the fall is being discounted? Has it been discounted adequately or too much? We don't know yet. We'll see how that plays out over the coming year. But I think the sharp de-ratings in the share prices against actually fairly robust NAVs, is such an interesting question. And there is a big disconnect I'm finding between what you read in the media about how disastrous property might be, and in particular how no one's ever going back to an office. And then you talk to the managers and they say, well, actually, we're finding there's still demand. People are paying their rents, no problems. We're putting through rent increases on many of our properties. Everything's looking much more robust. So, you have to choose who to believe there. And obviously there's vested interest, but, I think maybe the share prices, have overreacted a little bit. And it'll be interesting for some of the trusts, like Regional REIT, obviously has gone purely into offices. That's a big bet. We'll have to see how that plays out. But if you have faith and you think that actually the UK recession won't be too bad, then again, there's some good value here, and you can be paid a very, very nice yield of maybe 7-8%, while you wait. The other one I would just before we move on, just two I'll mention briefly. AEW UK REIT has been a tremendous performer over a long period of time now. I think the management is really, really good there, and you've got a good opportunity to buy in now on a good discount rating. They're second in the list over 1 year, and they're pretty near the top, or actually they're at the top over most periods. And the other one I'll just mention is Aberdeen Property Income. I talked about that last month and its wide discount, and that has actually narrowed quite a bit. There's been quite a bit of demand for the shares over the recent days.
Yeah, they refinance their debt, which is quite helpful, I think. Right, so healthcare, not much to say on here. It sort of keeps chuntering along, although you've seen Target being derated. I'm not sure why that should be. I mean, there are obviously concerns about generally across the whole of the property sector about rising interest rates and what that does to yields. And Andrew was saying that if you had industrials exposure, you did a bit better last year in the commercial property thing. That's obviously, if you these logistics things here, that's reflected there. But you've seen marked widening in the discounts, particularly for Triton's big box REIT. There is still an argument that there isn't enough of this space around. Vacancies are still quite low. That's driving rental growth. Even though yields will rise and so property valuations will fall, rising income will maybe offset that. And that's something that Richard here has written about extensively. And I do sort of subscribe to that. I think you can sort of see a way through this. So it's not all bad news on this sector, but definitely the other thing to look out for is obviously what they're paying in interest and how much fixed and floating rate they've got. Residential property, here we have one of the worst performing stocks of the year, Home REIT. That's I'm really not got much to add to that, to be honest. I really hope that it isn't true that they've been up to all sorts of shenanigans. And it's disappointing because I thought it was doing something useful. And I think that's definitely true of Civitas and Triple Point too, that they are fulfilling a useful function. But you have seen that discount completely collapse. The NAV returns, the beauty of what they were supposed to be doing there is that they've got a lot of inflation-linked income. So the higher inflation, that should have all been good news. Ground rents is decided to go up the ghost, given what's been all the sort of headwinds that it's had thrown against it over the years, and I think that's entirely sensible. I think they should maybe persevere with that, maybe even longer than they probably should have done. So I think, I know not quite there, Europe. Here again, you've got logistics, the top two there, and that's been driving the returns there. And again, you've got the discount widening. If anything, the story on the demand for property is maybe even more acute here, but you maybe got slightly less restrictions over the availability of land to build on. I think it depends on which market you're looking at, though. Netherlands and Germany is a bit different to sort of Spain and France and stuff. Otherwise, I don't think there's an awful lot to mention here. Macau had an interesting bounce towards the end of the year, partly because this sort of Chinese COVID thing changed, and the policy there means that you may get some more Chinese tourists hitting Macau, and that's obviously good news for those properties there. And SIBA is sort of perennially cheap. It really comes down to, will you ever see a dramatic improvement in US-Cuban relations? I hope so, but we'll have to wait and see. And therefore, we have got to the end. I know it's getting up for 15:15, so thank you for sticking with us. I should keep showing you the legal warnings because that's important. We'll be back next week, and as Andrew said, we're going to be talking to one of the managers of Vietnam Enterprise, and I think that is quite interesting because there's been derating. The underlying economy does look quite strong there, so that should be good news. Then we've got RTW, which, as I said, has had a few wins in its portfolio recently. And then we've also got the new manager of Ecofin US Renewables, which is a fund that actually has been doing very well operationally. And again, there's this sort of separation between its NAV and its share price. But that fall in the share price was really driven when the last management team walked out. So now it's got a new management team in place. I don't really see any reason why it wouldn't just get re-rated. And it's on about a sort of 12, 13 discount. So there's some decent potential upside there. We'll have to wait and see. Well, thank you for sticking with us. I hope that was useful, and we will hopefully see you next week. Thank you, Andrew.
Thank you.